Hello, traders. Gary Wagner here. Just before 1 o'clock in Honolulu, 7 o'clock in New York on Thursday, 19th day of August, 2021. And this is the daily report for gold and silver. For the third consecutive day, both silver and gold have closed lower, with lower highs and lower lows on the day. On today's report, we will talk about critical areas of resistance in the case of gold and support in the case of silver. We'll also take a much closer look at the US dollar because that closed at a record high for the year 2021. We'll look at some charts, but first to the price board. We have seen muted action in gold, with the last 3 days resulting in consecutive lower lows, lower highs, and lower closes. Today, gold closed down $1.90, is currently fixed at $1,782.50. It's a net decline of about 0.1%, and that really is dwarfed by dollar strength today, which is accounting for all of today's drawdown, because when you factor in the drawdown in gold of only 0.1% and the dollar going up by 0.5%, you can see that there was slight buying in the market, but that was certainly negated by dollar strength. We are currently at the highest trading value for the dollar index this year. It broke through 93.509 today. It's currently at 93.605, and you can see on a closing basis when we look at the chart at the lower left-hand side of the screen that we are definitely witnessing the dollar at its highest value this year. One of the greatest forces that has been pushing gold prices lower recently has been dollar strength. We're looking at a daily candlestick chart of the dollar index. What is noteworthy in terms of today's candle is if you look, there is no upper or lower wick or tail, which simply means that it opened at the low and closed at the high of the day. But what is most significant about gains in the dollar recently, and specifically today, is that it overtook the highest value that we have seen the dollar trade to in this calendar year, which was 93.489. Today we're at 93.605. You can clearly see that the market has exceeded the high that occurred at the end of March. And really, to take a look at that, we'll go ahead and compress this chart to indicate the wide range that dollar value has gone through this year, as well as the significance of today's upside move. Of course, the lowest trading value for the dollar occurred during the first month of 2021. It was trading just above 89. And from those lows seen in January of this year, we saw the dollar gain strength literally up until the last day of March, when it hit the former record high for this year, which came in, as I said, at 93.489. And then we saw a solid decline, although the decline itself took the dollar index to 89.50, so still well above the lows of January. But following the lows that we saw at the end of May, we have literally seen the dollar gain a little bit over 4% in value when compared to the lows achieved in May and current value of the dollar at 93.60. Which brings us to our current forecast and assessment of gold. Since the top that was achieved on Tuesday of this week, when we saw gold almost reach 1,800, 1798 to 1799 in terms of its high, we have seen a series of lower highs, a series of lower lows, as well as a series of lower closes. We are still under the belief that there is absolute resistance beginning at 1,800, and that is also corresponding now to the 50-day moving average at 1799.10, followed by the 100-day moving average at 1806, and then finally 1815, which is where the 200-day moving average currently resides. Although this recent activity of the market taking incremental and fractional steps to lower pricing tells me that we probably have hit a top. If that's the case, I would look for more downside pressure. As we have spoken about, it is my current belief that gold remains in a bearish posture. One way to illustrate that is the positioning of the three relative moving averages that we are looking at. In full bearish formation, you would have the longest term, in this case, the 200-day moving average, having the highest value, followed by the 100-day, and then by the 50-day. To be in full bullish alignment, it would be exactly the opposite, with the short-term 50-day moving average above the 100-day moving average, which would be above the 200-day. Based upon that, I believe that we saw a 5 count on the way down. We are in some sort of an ABC correction. I believe that we have completed or are coming close to completing the first part, which is our A wave that could have occurred on Tuesday of this week. If we see a further decline in pricing, I would look for this market to go anywhere between 50 and 75% of the gains seen in the A wave. That would complete our B wave. And then our C wave by nature would go above the highs that were achieved during the A wave. If they were equal, as I said yesterday, it would be called a flat, or this would be a normal zigzag or ABC correction. Now, there are multiple types of corrections. One other type of correction is, rather than a straight A, B, or C, it is sort of like a compression triangle. You will typically get a total of 5 waves. So you would get something like an A, a B, a C, a D, then you would get your E, and then the final wave would be called a thrust, and it would go in the primary direction of the prevalent trend, which is down. And that would be another way that we could see this unfold, although we won't know that until we get a little bit more data and price movement. I did get a question sent to us by one of our subscribers that asked if there was any time element that we could predict in terms of how long any part of any given wave would last. Wow, Elliott wave is very good when used with Fibonacci at letting us know the relative trend and our placement within the trend. The one thing that Elliott wave does not do is account for time. That's the simple answer, but it is also the most complete answer I can offer the question raised. For right now, we are going to maintain our neutral stance. If we do see further weakness in the market, we will certainly look to buy either at 1738 or 1708 if we see the market dip this low. Aggressive traders can look to initiate short positions if we get a break below, call it 1770, which is the 23.6% Fibonacci retracement of this particular rally. Silver also continues a downward spiral with the last 3 consecutive days, resulting in lower highs, lower lows, and lower closing prices. The key distinction between silver and gold is, while over the last 3 days we have seen lower pricing in both markets, after the jobs report, serious price decline in both gold and silver. Gold really rallied sharply higher, and silver traded sideways with really only one strong up day out of the last 8 trading days. Currently, we have September silver at $23.22.5. That's down almost 20 cents on the day, a net decline of 0.84%. As far as our assessment of silver pricing, I still believe that there is more potential downside. As you can see, I have greatly compressed the chart to bring in the full length of the data set used for the Fib retracement. It begins at about $21.85 up until around $30 per ounce. We could see that we had a major support level breach, that is the 78% retracement. That to me is a key and critical area. We have good historical data suggesting that this is an important price point, such as these lows here, or these series of lows that come in here back in December of last year. Once we broke through there, on a technical basis, there really isn't any support until we get to a series of lows. One of the lows that we could look at come in at around $22.50. And then below that, of course, are the lows achieved just below $22 per ounce. So we could see further downside. We still have this one low that we would need to break, but if we do break that on a technical basis, we could challenge these recent lows that came in immediately following the jobs report. This has been Gary Wagner wishing you, as always, good trading. We will talk to you tomorrow for the weekly wrap-up and review. Bye-bye.